Hello everyone, welcome. We will continue with capital gains tax in this lesson. We have done a couple of lectures before as well. So this lecture will continue with the capital gains tax. Now we will look at the shares aspect and some more aspects as well for capital gains tax, including the reliefs which are available to us in capital gains tax. First of all, let's look at the shares without wasting time. So I'll just share the screen with you and we will read the notes together, and I'll be explaining from the notes. So if you could please come to page 51 of your lecture notes. I'm sharing the screen with you anyway, but if you have the notes in front of you, please come to page 51 of your lecture notes. Now it says disposal of shares. Now sometimes what happens is that as part of capital gains tax, if you sell some shares instead of the asset, so if you sell some shares, you could make a gain on that, you could make a profit on that, and on that profit as well we will have to pay capital gains tax. Now how to calculate capital gains tax as far as shares are concerned? First of all, what we do is we will take the sales. Obviously when we are selling the shares, so we'll have to take the sales. Say for example you had 100 shares and you sold it £5 each, so sales proceed is going to be £500. Now till here sales proceed is not a problem, you can do it easily. Now as far as cost is concerned, cost is a little bit difficult to determine, because although you have 100 shares which you have sold, but cost of them 100 shares is not easy to determine. Reason is because you haven't bought all of the 100 shares at once. You have been buying the shares, so you have bought 20 shares once, then you bought 30 shares, then you bought 30, then you bought 20 again. So you have been buying shares, small shares like 20 shares, 30 shares, 10 shares, and now you have sold 100 shares. Now when you have been buying shares at different timings, some shares in February, some shares in March, and some shares in other dates as well. Now because you have been buying shares at different dates, so the prices of the shares at which you are buying the shares were different as well, because the price depends on when you're buying. So some shares you bought were worth £2 each, some of them you bought were worth, say for example, £3 each, and then £3.50 each, and whatever. So when I am taking the sales, although I have already took the sales, but when I will determine the cost of the shares, it's not easy to determine because I will have more than 100 shares. So that's why it is difficult that how to determine the cost, how to determine the actual cost of these shares which I am going to sell. Now there is a certain way to calculate the cost, so that's what we will follow now from the notes. So it says share pool. First of all it says the share pool. Now what happens is that, just leave the share pools for now. If you just go beneath that where it says matching shares on sale of shares for individuals. Now it says shares sold will be matched in the following order. So we'll use this order when we are calculating the cost of the shares. So first of all we'll take shares purchased on the same day. So if you are selling the shares on 31st of December, so if you have bought any shares on the same date, you'll have to take the cost of them first. Now the second preference is shares purchased on the following 30 days. If you bought any shares in the following 30 days, then we'll have to take the cost of them shares as well. Then if still you need to take some cost because you haven't taken the cost of 100 shares yet, you haven't taken the cost of full shares yet, then the last preference is going to be share pool. We'll take the remaining shares and their cost from the share pool. Now what is the share pool? All of the remaining shares will go into the share pool. So in the share pool what we do is we'll put the shares, then put the cost of them shares as well. Then we buy some more shares, we'll put some shares, excuse me, and then we'll put them cost as well. So there will be different costs in different shares, and then we'll add all of them, and whatever the total cost is, we'll divide them by shares. That is the cost of per share. So now just look on top of that, now on top of the page where it says share pool. Now we'll read the share pool now. It says consist of all the shares purchased before the date of disposal. So it will consist all of the shares purchased before the date of disposal, excluding the same day and the following 30-day one. Now two tracks are maintained. So first of one, which will be number of shares, and then the second one will be the cost, as I said to you earlier. So when the shares are sold, then the cost of the shares in the share pool is apportioned according to the number of shares sold in the pool. So whatever number of shares we have sold will multiply by the cost per share, and that will be the cost of the shares. Now sometimes, you know, you have studied F3, F7, P2, so you know at this level what right shares are. So if you hold some shares, then you buy some more shares, the company will give you some preference, and so you can have some more shares as well, with the percentage, with the proportion of the shares you already hold. Now these shares are called right share, but there is something called bonus shares as well, the next one. Only difference between right share and the bonus share is that in the bonus share you don't have to pay anything, whereas in the right share you have to pay something for that, right? So then the next one, it says reorganization and takeover. Now what happens is sometimes you hold some shares in a company. Say for example it was Z Limited, so you hold some shares in Z Limited, but Z Limited was took over by Y Limited. So the company where you hold some shares was took over by another company. Now the new company will give you their shares, and you will give the shares you hold, you will give it back to the new company. So this thing is called reorganization or takeover. Now we'll calculate the cost of the new shares according to the shares we already had, and we'll check the market price of the new shares as well. So by doing that, we'll see the actual cost of the new shares and the new shares, number of new shares as well. Now when we will hold the new shares of the company, then our number of shares might be increased, and it could decrease as well depending on the market price of the shares. Now sometimes the new company will give you cash as well and the shares in their own company. Now it depends on different scenarios, but we will see a question on that, and please make sure you mark it as important. It is one of the important topics of ACCA P6 taxation. Next one, it says quoted shares. Now whenever you have gifted some quoted shares, what is the way to calculate? Excuse me. Now obviously when you're gifting something, then you are not charging anything from them. Although you're not charging anything from them, but for capital gains purposes, we will take sales proceed will be the market price of them, of that gift, whatever it be. So when quoted shares are gifted, the sales value will be market value for capital gains purposes will be, now we'll take lower of these two. Now lower of what two? The first one is lower quoted price, which will be given to you in the exam, plus 1/2 of difference between higher quoted price and lower quoted price. That will be given to you in the exam. Higher quoted price and lower quoted price will be given to you in the exam. So what you do is you'll take lower quoted price plus 1/2 of a difference between higher and lower quoted price. And the second one is average of marked bargain. Now highest marked bargain and the lowest marked bargain will be given to you in the exam, and what you need to do is you will have to add both of them and divide by 2, which will give you the average of marked bargain. So we'll have to take lower of these two, and that will be our market price of quoted shares, right? Now on the next page, if you move to page number 52, don't worry about quoted shares as well. We'll do a question on that as well in the next video or the following video. Now if you come to next page, which is page number 52, it says capital gains tax for the companies. Now almost everything is exactly the same. The only difference is that individuals get the annual allowance, as I said, 11,100, whereas companies do not get any annual allowance, but instead what they get is indexation allowance. Now indexation allowance basically involves inflation and other economic factors. So whenever the price is changing due to the time and price rise, which is inflation, it will be incorporated into the indexation allowance. So we'll have to deduct the indexation allowance as well. So companies won't get any annual allowance. However, what they get is indexation allowance. So that is the pro forma of capital chargeable gains for companies. We'll take sales and we'll deduct the incidental cost of sales, and we'll deduct cost and enhancement expenditure out of that, and that will be known as unindexed gain. Out of that, we'll have to deduct the indexation allowance, and then indexation allowance, when calculating indexation allowance, we'll have to calculate it both on the cost and enhancement expenditure, and the remaining is going to be indexed gain. And out of that, we'll have to deduct the capital loss, current year one, and if we have any remaining carry forward, we'll have to, brought forward one, we'll have to deduct that one as well, and the remaining is going to be chargeable gain. Now this is the this is the standard pro forma of chargeable gain. Now only new thing is indexation allowance. How to calculate indexation allowance? There are two ways which are given beneath that. One is index cost. We'll have to deduct cost out of that. Index cost less cost is equal to indexation allowance. The second way, which is a normal way, which we normally do during our question, is indexation factor, which will be either given to you in the exam, or we can calculate multiplied by cost. So index factor multiplied by cost, it is going to be our indexation allowance. Now just beneath that, it says that how to calculate the index factor. Now say for example, if index factor is not given to you in the question, then how to calculate index factor. Now if index factor is not given, another thing will be given to you in the question, which is known as a retail price index, or RPI. Now two RPIs will be given to you. One is RPI at the date of sales, another one is RPI at the date of purchase. So what we do is we'll deduct RPI in the month of sales less RPI in the month of purchase divided by RPI in the month of purchase, and that will be our index factor, and we'll have to multiply it by cost or the enhancement expenditure, and that is going to be our indexation allowance, right? That is for companies. We'll do one question on this one as well. Actually, we will do the reliefs for capital gains tax in this video. Then we will do some indexation allowance as well, and then you will understand this one better. Sorry, I forgot to move the screen as well. Right, then now we'll look at the disposal of substantial shareholding. Now that is the reason I mostly ask you to keep your notes in front of you instead of just looking at the screen, because sometimes I forgot to scroll down the screen. So that's why I always ask you to keep the notes in front of you, which you can download from our website. Next thing is SSE, excuse me, a substantial shareholding exemption. Now what happens is that when one trading company owns 10% or more shares in another trading company, and when they sell the shares, now that gain will be exempt. Why it will be exempt? Because it is substantial shareholding exemption. So when one trading company holds substantial shareholding in another trading company, the gain on that is going to be exempt. Now what does substantial shareholding mean? Substantial shareholding simply means more than 10% or 10%. So that's what it says in notes as well. Gain on sale of shares by company is exempt if company is a substantial shareholding. Substantial shareholding is when a trading company holds 10% or more shares in another trading company. Exemption applies to the disposal or the part disposal. The exemption applies to disposal of part of the substantial shareholding if 10% holding test is satisfied for the continuous 12 months in the previous 2 years. Now another condition for this one is that you must have hold the shares for consecutive 12 months out of the last 24 months. Right? Now this is also one of the important topics, so we'll try to do one question on this one as well. So this is a substantial shareholding exemption, and it is very, very important from theoretical aspects. So in the huge question, examiner might give you a small portion of substantial shareholding. So he will be just testing about the substantial shareholding. Within the long question, there will be small portion about substantial shareholding exemption for the couple of marks. So you just need to communicate to the examiner that you know about substantial shareholding. Just remember this rule, which is the small one. When one trading company holds shares in another trading company, now shares means 10% or more shares. So when one trading company owns more than 10% or 10% shares in another trading company, and then shares has been held for a consecutive 12 months of the last 24 months, then the gain on that is going to be exempt under the substantial shareholding exemption. Now if you come to page number 53, I'm just leaving the page number 53 for now. and we will continue in the next video or the video after that. I'm just continuing with page number 54 for now. Please come to page number 54 where we see the rollover relief. Now there are some reliefs available for capital gains tax purposes, one of which we have already seen, which was entrepreneurs relief. Now if we are qualified for entrepreneur relief, we know that we have to pay tax at the reduced rate of 10% instead of 18, 28, 10 or 20% respectively of different things, right? So we will be paying tax at the rate of 10% if our disposal is qualified for entrepreneurs relief. Now there are some other reliefs as well. Now these reliefs which we are going to read now, these are deferral reliefs. When I say deferral reliefs, it means that we won't have to pay tax now on the gain. We will just defer it. We will just have to, we're just postponing it so that we'll have to pay tax later. So it is not exemption. We are not ignoring it. We are not relieving out of that. We will have to pay tax, but we are just deferring it for the future periods. So that's why these are known as deferral reliefs. The first one of which is rollover relief. Excuse me. Now what happens is that if you have sold an asset, and if you have sold an asset and whatever the proceeds of them sales are, if you have reinvested whole proceeds into another asset, then gain on the first asset is going to be deferred. It is going to be rolled over, so you don't have to pay any tax on that asset, on that gain. So if you have sold an asset and the whole proceeds which you get out of that sales, if you're reinvesting them whole proceeds into another asset, then gain on the first asset is going to be rolled over. Now what happens sometimes that if you have sold this asset, you have sold for £100,000, but the new asset which you bought, the second asset which you bought was worth £80,000, which means that you are not reinvesting the whole amount. You are just reinvesting £80,000, 80%. Now in that case, amount which you have not reinvested is going to be taxable immediately, and amount which you have reinvested is going to be deferred, is going to be rolled over. Now when I say rolled over, we don't have to pay tax now, but we will have to pay tax in the future. Now how will we have to pay tax? We will see in the notes now. Now as you can see on your screen, it says old business asset. Now the old business asset means first asset. So we have sold it, we'll take sales less cost, and if it is a company, we'll have to deduct the indexation allowance as well, and out of that we'll have to deduct amount not reinvested. Now amount not reinvested, in my example, it was £20,000 which was not reinvested. Now amount not reinvested is going to be chargeable gain. We have to pay tax immediately on that. And the remaining amount, which is ABC, it says gain rollover. Now we are not paying tax now on this. We will have to pay tax on that in the future. Now the new asset in which we have reinvested the amount, just beneath that it says it is no non-depreciating asset, which is land and building. At this level, non-depreciating means land and building has got infinite life, so that's why we're calling it as non-depreciating. Now the new asset where we have reinvested the money is land and building. Now if it is land and building, how will we calculate the gain on the new asset? The second asset. So when we have sold the second asset, we'll take the sales proceeds. Now we will have to calculate the cost out of that. Now we'll take the actual cost and we will deduct the rollover gain which we have rolled over earlier on the previous asset. If you just see above that, it's ABC above that. Now this gain rolled over was ABC. Now we are deducting that ABC out of this one, out of this new asset's cost. Now when we are deducting that gain, that deferred gain out of this new asset's cost, it means that cost will be reduced. When cost will be reduced, then the gain will be higher. So which means we are repaying now the gain which we deferred earlier. We are paying tax now on that, right? So that is the way to calculate it. So we'll take the sales less cost, and we'll take the sales less base cost. So in the base cost we'll take the cost and we'll deduct the rollover relief, and then we'll deduct the indexation allowance out of that as well, and the remaining amount is going to be chargeable gain. Now when we are selling the new asset, only then we will have to pay, we'll have to pay tax not only on normal gain but also on the gain which we have deferred earlier by reducing the cost of new asset. Right, so that is a way to calculate rollover relief for rollover relief when we have reinvested in non-depreciating asset. Now we will look at an example relevant to rollover relief. Then you will understand this concept in a better way. I know that you have already understood, but we will just do an example. Bear me 1 second. If you come to page number 64, please. I've already given you the examples and I've shown the answers as well, so you can just see it, but we will go through together so that you can understand as well if there is any problem. So it says D Limited, as you can see on your screen, D Limited purchased a factory in April 2000. When he purchased the factory, the RPI was, retail price index, was 170.1. Now why did he give us this RPI? In order to calculate the indexation allowance, in order to calculate the index factor. That's why he gave us this amount. Now he bought it at the cost of £120,000. It used the factory in its trade throughout the period of ownership. In August 2016, he sold the factory for £220,000. Now this is the sales. We'll take sales proceeds and the amount is £220,000. Now this is the sales. We'll have to deduct cost out of that, and cost was £120,000. So £220,000 less £220,000 less £120,000. So that is going to be our unindexed gain. Let me show you the answer as well. So that is going to be our unindexed gain. Now what we have to do is we'll have to calculate the index factor, indexation allowance. So RPI in the month of sales less RPI in the month of purchase over RPI in the month of purchase multiplied by the cost. So if you do like that, that is our indexation allowance, and after that it is going to be our indexed gain after deducting the indexation allowance, as we have seen earlier. Right, then it is our indexed gain. Now what we need to do is we'll have to figure out that how much of the money is not reinvested. Now the money not reinvested is going to be chargeable immediately. Let's read the question again. So it says D Limited sold the factory for £220,000. It purchased another factory and cost was £190,000. Now he sold the earlier factory for £220,000, whereas he has reinvested £190,000. So the amount not reinvested is £30,000, which will be chargeable immediately, and the rest of the amount is going to be rollover relief. So let's just look at the answer. Amount not reinvested is £30,000, which is chargeable immediately, and the balancing figure is going to be our rollover relief. Now because he has reinvested in a factory, in the new factory, so what we need to do is we'll have to calculate when this rollover relief is going to be taxable. So in order to do that, we have to calculate the base cost of the new factory as well. So if we just look after that on the next page, so it is the cost of the second factory. Cost of the second factory was £190,000. We already know it. Now this cost will be reduced by the rollover relief which we have calculated earlier. Now this rollover relief was balancing figure of 7,720. Now it will reduce the cost. So the base cost is going to be £182,000, 280, and that is going to be our base cost, which will be deducted out of the new factory when we sell that. Right? Now when this cost is reduced, it means that it is going to be taxable. When cost is reduced, gain is going to be higher, so we'll have to pay more tax. Right? Now going back to where we were before, we were doing rollover relief. We have done this one. Now let's look at the second rollover relief. Now when I say second rollover relief, it means that it could happen that if in the first case I've invested in non-depreciating asset. What if I invest in depreciating asset? What would happen in that case? Now let's look at this example which you can see on your screen. Now it is sometimes known as holdover relief as well, because it is held for some period. So what happens is that we'll take the sales and cost of sales and we'll deduct the indexation allowance if it is a company. Then amount not reinvested is going to be chargeable immediately, we know that. And the amount which we have reinvested is going to be our rollover relief or held over. Now it will be held over, it will be rolled over until the earliest of. There are three things given: until the earliest of. So it will be held over, it will not be chargeable until earliest of this event happen. Now earliest of what? Sale of new asset, the new asset which we have bought, where we have reinvested the money. If you sell that asset, or 10 years, or new asset cease to be business asset. So whichever event come first, on that date, this rolled over gain is going to be taxable. Right? Now, assuming that new business is going to be depreciating asset, which is plant and machinery, in that case, what would happen? We'll take the sales and we'll deduct the cost out of that, and if there is any indexation allowance, if it is a company, we'll deduct that as well, and that is going to be our chargeable gain. Now in that chargeable gain, we will add the chargeable gain which we have deferred earlier, right? So unfreeze gain, we will add this one here, and we'll total that is going to be our total chargeable gain, and on that we will have to pay tax. Now in the non-depreciating one, we were reducing the cost, whereas in the depreciating one, we are adding in the gain. So it's exactly the same thing almost, but there is a different way to do it. So we'll have to pay capital gains tax on this one as well, if it is a depreciating asset. Now let's do an example on that as well, so that you can understand this one better as well. Bear me 1 second. Yeah, this one, as you can see on your screen. Let me go back to my on my iPad as well. Right then. Yep. Norma bought a freehold shop for use in her business, and she bought it for £125,000 and she sold it for £140,000. So sales is £140,000, cost is £125,000, and the gain is going to be £15,000. Norma bought some fixed plant and machinery to use in her business, costing £150,000. So which means that she has reinvested the whole amount. So the whole gain is going to be deferred, whole gain is going to be held over, and when it says whole gain is going to be held over, so we'll have to see the treatment of the new asset as well. She then sells the plant and machinery for £167,000 on 19th of November 2018. So she sold for £170,000. Now we'll have to see the sales and cost of the new asset as well. So sales was £167,000, cost was £150,000, and the gain is going to be £17,000. Now the earlier gain which we have deferred, £15,000, that will be added in this gain, and we'll have to pay tax, we'll have to pay capital gains tax on both of them, and total is going to be £32,000 on which we have to pay, we'll have to pay capital gains tax. Right? Right then. Now we'll have to see the next one. If you come to page number 55, please. What are the conditions for rollover relief? Under what conditions can we have the rollover relief? So again, may be rolled over where proceeds on disposal of business asset are spent on replacement business asset. In order to roll over, the following condition must be satisfied: old and the new business asset both must be used in the trade by the person claiming the rollover relief. So it must be used in the trade. Old and the new asset bought are both land and building or the plant and machinery. So the old asset and the new asset could be either plant and machinery or land and building. It can't be anything else. A reinvestment of the proceeds received on the disposal of old asset takes place in the period beginning 1 year before and 3 years after the disposal. So what you can do is you can buy you can buy the replacement asset between these 4-year span period. Now this 4-year span period is 1 year before and 3 years after the disposal of the first asset. All right. Now these are the conditions for rollover relief. Please make sure you mark these as important. These are very, very important, and the examiner can examine in theoretical aspect of P6.